Hi, this is Greg. Welcome to the channel. If you're new to the channel, we talk about business and investment. And in this episode, we're going to be talking about should you buy Verizon stock now? Now, the reason this came on my radar screen is because world famous Warren Buffett, the famous investor, just purchased $4.8 billion worth of the stock. And that's why it came on my radar screen. And we're going to be talking about it right now. Hey, so this week it came to light that Warren Buffett, the famed investor, the Oracle of Omaha, made a large investment in Verizon, $4.8 billion worth, and it came on my radar. I was actually already looking at the stock, and I mentioned it in one of my previous videos when I talked about dividend stocks. So I was already watching it, but when the news came out, it sparked my attention that much more. And on this video, we're going to take a look at the company, do a deep dive into it, and try and figure out exactly why Mr. Buffett made this investment and try to decide if this would be right for us to go into this stock also. Now, I was already looking at this stock, as I said previously. I was watching it, and I noticed it took, quite a dive over the last few months, down, 10-15%. And I noticed that after news came out that Warren Buffett bought $4.8 billion worth of the stock immediately went up about 5%. So even though it's a little bit higher now, I think it's still in the realm of being attractive from a valuation standpoint. So let's take a look at the details right now. Okay, so I wanted to share my screen here. Hopefully you can see this okay. These are some of the basic facts of the company. The company in its current form was started June 30th, 2000. It's one of the world's leading providers of technology and communications, information, and entertainment products and services. I'm sure everyone who's watching this video has heard of the company. The CEO is 𝐤𝐨𝐬𝐵. And he, I don't know how long he's been CEO, but the revenues of the company are huge, $128 billion. They paid out dividends of $10.2 billion. They're ranked on the Fortune 500 ranking of number 20. They have 132,000 employees, 1,600 retail locations, and it's an international company. It serves 150 different companies. The company itself was one of the first companies to launch the 5G system, which we'll talk about a little bit later, which is an advancement in technology for the wireless system. The company has basically three customer-facing operating groups that generate the revenue and comprise most of their business: the consumer, business, and media groups. Let's just take a quick look here at the key financials. The company is very profitable. They reported fully diluted earnings per share of $4.30 per share. And what fully diluted means is that you take all the shares plus you add in those shares that were given to management for compensation purposes in the form of stock options, and you add those in, and that's the fully diluted earnings per share. Net cash provided by operating activities, which is not the same as free cash flow. We'll talk about that later. But a very impressive $41.8 billion. So the company makes a lot of money. It has a varied and far-reaching business that we'll talk about a little bit more in a minute. They make capital expenditures per year of $18.2 billion. They pay a quarterly dividend of 62.75 per share. That equates to about a 4.4% dividend, and there's 4.138 billion shares outstanding. Okay, here you can see in the chart, they have 94.4 million retail connections. You can see here the dispersion of their various business groups. They have 90.3 postpaid connections, 13.4 million Fios digital connections, which is internet and video. And they had revenues in the fourth quarter of 2020 of $23.9 billion. That's in the consumer group. The business group that you can see on the chart here, 26.5 million retail connections for the business group. As I said previously, they're first in the world to offer the 5G network, okay, which increases the speed and the connectivity and performance, basically, of their network. And this business group had $8.1 billion in revenue, fourth quarter of 20. Verizon Media Group, which is the third group, has 13 brands. That's creating, as they say, what's next in content, advertising, and technology. It's accessed by over 900 million people over the world, and it is the smallest contributing group of 2.3 billion. So most of their business clearly is consumer and business, and it's mostly wired landline service to homes and businesses, as well as an enormous wireless business and their internet and, of course, their video service. Okay, let's jump over to my trading account. Here you see the snapshot of the stock itself. It closed today at $56.98, almost $57 a share, down slightly. Heavy volume. It's a heavy volume stock. It's one of the most heavily traded stocks on the New York Stock Exchange. It has a market cap of $235 billion. So it's a very large company. It's, as I said before, it's got 4.1 billion shares outstanding. Here's something that I'm sure Warren Buffett is focusing on. The PE ratio is 13.26 times expected EPS. Projected EPS is $4.41. As I said previously, the dividend on this stock is quite nice. It's not one of the highest, but it may be one of the most reliable, because I went back and I checked, and it seems like they have increased the dividend over many, many years, and they have paid the dividend over many, many years. So that's another thing that I particularly look for. And I'm sure Warren Buffett considered this, although he does not buy stocks based on just the dividend. He's looking for profitability and, of course, value. I want to take a quick look here at the fundamentals. Let's go over here. Let me see what I want to look at here. The PE ratio is relatively low for this market, but I think that that's because of the almost utility-like characteristic of this company. It's not one of these very exciting, growth stocks, right, that we like to look at or we like to invest in to get massive capital appreciation. What here you're looking for is steady earnings, steady as she goes. You're buying value, and I believe that you're buying also a very nice dividend yield, which you can reinvest in a DRIP program and buy more shares and achieve this compounding effect that we've talked about so much on this channel. That's so very important to your future. Take a look at the profitability, though. Gross margin of over 60%. That's very attractive. Operating margin almost 21%. EBITDA 36.5%. Okay, that is basically cash flow before capex. Net profit of 14.3, which is not bad. And the dividends is another thing I'm focusing on, 4.4%. The payout ratio is 43%, which means that they have more free cash flow than they are paying out. They're retaining earnings. They're not paying out all of their retained earnings, which is good. That means there is a cushion, and that's a positive vis-a-vis the dividend. All right. One thing that I always focus on, and I know that Warren Buffett focuses on, and if you saw my video on Intel, you would understand this, because we looked at Intel and it had free cash flow of $18.5 billion. Let's take a look at this company. And free cash flow is basically what we look at when we look at cash from operations, which is this number here, which is basically how much cash are the basic operations generating. And then we take from that, we reduce from that the CapEx. Now, where's the CapEx? Let's find the CapEx. CapEx. Here it is. Okay, so here is CapEx. And we can see if you subtract this number from CapEx, you get about roughly $21-22 billion. That is the amount of free cash flow that this company throws off, which is an enormous amount of money. And that augurs well for potentially the future growth and the future investment that the company can make in its businesses, but also money that can be freed up to pay your dividends, and more importantly, to increase the dividends as time goes on. Now, lastly, I wanted to look at the chart. You can see the chart here. This is the last year. This is the last 5 years. You can see, I mean, to me, this chart doesn't really excite me because the stock really hasn't gone anywhere. Okay? And if you look at this, you can see, I was looking at the stock in this time frame here, because I saw that it sold off from 62 down to 54, which was a nice sell-off, and I was starting to get interested in it, because if you see these patterns of the up and down, it was trading at the low part of the range. And right here is where the announcement came out about Warren Buffett. You can see it gapped up about 5%. Although the stock is not exciting from a growth standpoint, I said before, I'm really not buying this for some high-flying growth. I'm buying it for stability. I'm buying it for earnings, modest earnings growth, and I'm buying it for the enormous cash flow that it throws off. And I can look forward to having the dividends increasing over time if I were to own this for the long term. And I'm sure that's what Warren Buffett is focusing on, the retained earnings and the free cash flow. One thing I did want to do, let's go back here to the snapshot, and this is sort of a referral to my previous videos, and I'll put a link in the description. I did a video called Trade Stocks Like I Do, where I went into these technical measures that I look at in enormous detail. But let's just take a quick look at this. I just wanted to show you. If you look at this here, you can see these are the Bollinger Bands, which is basically one standard deviation above the 50-day moving average, above and below. These are the Bollinger Bands. And this is the slow stochastics that I look at. These are other measures that I look at too, but I'm just focusing on these two right now. And you can see that as far as the trading range is, it's with the Warren Buffett bump up, it's getting close to its upper range on the Bollinger Bands, whereas in that other period I was referring to, here it hit the Bollinger Band, which would mean it was oversold, and here in the slow stochastics it's oversold, and here again you could argue that it was oversold. It's not in an oversold position. I'm just saying this from a trading standpoint. If you're a long-term holder, it doesn't really matter at this point, because it's got a nice dividend yield and you'll get the growth over time. Okay, so what are we thinking about this after we do a deep dive into this particular company. I think that I do understand why Warren Buffett made this purchase. This is the type of stock that appeals to me as a financial person and as someone who likes to buy real companies, likes to buy companies with franchise value that have really incredible businesses that are not going anywhere. And once you build out all this fiber and you have the incredible network that Verizon has and the incredible number of customers, it's very difficult to knock a Verizon off its pedestal. And those are the types of franchise opportunities that I look for. And you probably have surmised, if you look at some of my other videos, these are the type of companies like Exxon, Chevron, Intel. These are real companies. We've also looked at some IPOs and some pure growth plays, like Airbnb was one of my favorites. And we recently looked at DraftKings. I think that if you're looking for a conservative investment where over time you're not going to lose money and over time you're going to make a nice dividend, not as much as Exxon, but I think there's more risk with Exxon. This is a nice risk-adjusted return on the dividend, and you do have the prospect of capital appreciation in the future as you own the stock and as you move forward with this stock. Now, you can either trade this stock when it gets to the lower end of the range. I don't personally think it's the best trading stock, or better, which is really what Warren Buffett has done here. You can own it for the long term, put it in your portfolio, and I think you'll be very happy long term that you did. I'm looking forward to you subscribing so you can be on board for future presentations, which will be coming your way very soon.